And this afternoon, St George Bank joined the rush to raise rates. It will lift its variable mortgage rate by 12 basis points to 7.42% from next week. That's more than the Big Four. Well, investors put a rocket under Westfield shares today on the group's plans to sell a major stake in 12 US shopping centres. Canada's Pension Plan Investment Board is buying a 45% share in the centres, valued at nearly $5 billion. But Westfield's decision to reduce its US exposure might be coming just when the American consumer is bouncing back. Neil Woolridge reports.
It's been a torrid time for retailers, but the world's biggest landlord, Westfield, is at last giving its investors something to cheer about after 4 very lean years on the stock market. On top of delivering a 38% increase in half-year profit, Westfield has announced plans to buy back 10% of its shares, offload 3 UK centres for $240 million and sell a 45% stake in 12 US centres to Canada's Pension Plan Investment Board, which will deliver $1.75 billion in cash to Westfield.
When you look at the mix of assets, it really suited what CPP was looking for, where you have stable assets with very good incomes and strong income growth in what I would call very high-end markets.
The US is over-retailed. In other words, there's too many stores. Not just because many stores over-invested, but also because with online and other modes of spending, this floor space has to decrease in many sectors.
I think what they're doing there is trying to reduce exposure to some of the more low-growth assets that they have and looking to use some of that capital to expand into other higher-growth markets.
Mark Galopoulos says Westfield's decision helps improve its return on equity and recycle cash.
Westfield have had a strategy for some time now of joint venturing on some of their assets, and the Canadian Pension Plan, obviously a very large asset holder, is a good long-term partner for them, and I think that that's going to be part of their long-term strategy.
Westfield's 3-prong announcement was a hit with investors, and its share price rose 5% in a flat market, although it remains half the level it was. The joint venture with the Canadian Pension Plan might now be seen as a vote of no confidence in the US consumer.
We think that there's actually quite a lot of resilience that's providing the support for most retailers' sales. On the other side, the high jobless rate, low wage growth, mix those two together and you get, we think, a somewhat muted recovery in consumer spending.
We achieved 2% this year in the United States, which was at the higher end of where we thought we would be. I think we'll be a bit better than that this year.
But official figures show US retail spending grew just 0.4% in January and credit growth remains weak. Chad Padowitz says there are better opportunities for retailers and landlords like Westfield in developing economies.
That's quite obvious when you just take the amount of GDP spending on consumer savings rates, growth of population, all those various factors. It's very easy to plot a path of consumption growth that's 4 or 5 times greater growth rate than the US.
But Westfield remains anchored in the developed world, and wherever it chooses to expand next, bricks and mortar retailers around the world will face more pressure from online shopping, meaning Westfield may have to trim its expectations for any future rent rises, even in its stronger markets like Brazil and Australia.